Hello and welcome to the lecture for Module 3. Today we're going to talk about bond valuation and stock valuation. I'm actually going to break this lecture up into two parts, so we'll do the bond valuation first, then I'm going to move over into Excel and do the examples in Excel, and then I'll post another video on the stock valuation and do some examples with that. I have also posted some videos, Excel videos on how to do the bond calculations in Excel, but I will do them for these examples as well. So you have both, so that's it. And I will also post these slides for you as well. Also, I have a slight cold, so if you hear me sniffling, I apologize, but I have a little bit of a runny nose. So let's get into it with bonds. So the first thing we need to do is go over some bond terminology, because you don't know what to do if you don't know what any of these words mean. So one term that you'll see thrown around a lot is par value. Okay, and that is also the face value of the bond. And that's the amount that the issuer promises to pay the holder upon maturity. So I guess before we talk about this, let's talk about how bonds work. Essentially, someone will sell a bond, you give them the money, and then they pay you a certain coupon rate at a certain period of time. At the end of the maturity, you get whatever value of that bond is. So they're essentially borrowing money from you, and you get paid using the coupon rate of the bond. There's also the market rate that will come into play as well, and we'll get into that more when we do the calculations. So for right now, the par value, or the face value, is the amount that the issuer promises to pay the holder upon maturity. So when the bond is mature, say if it's a 5-year bond and the face value is $1,000, at the end of 5 years, you will get back the $1,000 after 5 years. The coupon rate is the interest that's paid by the bond issuer, or the person who sells the bond, and that's based on the par value of the bond. So if you have a $1,000 par value bond, the interest will be based on that value. It's not based on the value that you buy the bond for, which could be a different value, which we will again get into. But you have a coupon rate, and that is the interest that you get paid based on the par value of the bond. Next, we have the coupon payment, and that is the payment that the holder gets based on the coupon rate. So again, if the par value of the bond is $1,000 and the coupon rate is 10%, the coupon payment is going to be that $100 if it's an annual payment until it actually matures. And when we see FV here, we have to be careful, because when we're talking about bonds, this means face value. Okay, the face value, I know that we were seeing FV as future value. It could also be used as that, because that is what you would get at the end of maturity for the bond, but you also need to be aware that this is really the face value, or the par value of the bond. Then we have the maturity date, and the maturity date is when the bond becomes due. So again, if it's a 5-year bond, in 5 years it matures, and that's when the bond becomes due, and that's when the issuer gives you the value of the bond, the face value of the bond, back. We have coupon yield, which is the rate of return that the bond generates. And then we have yield to maturity. So we're going to calculate this as well, and that's the yield received on the bond investment if it is held until it matures, based on the compounding coupon amount. And that is if the bond is held until maturity, so until the very end of the term of the bond, of the maturity date. And then we have bonds that can be called early. Sometimes there will be a 10-year bond, but it can be called in 7 years. So in that case, we would find out what the yield is if the issuer decides to call the bond early. And that would be a different yield, right? That's a different annual rate, or the rate that is being earned on the bond. So let's look at this example. Just to go over some of the concepts of the bonds. The calculations I will show you how to do in Excel, but I'll give you the basic rundown on how this works. So what is the value today of a bond that matures in 10 years, has a 10% coupon payment, assume the face value is $1,000, assume the interest rate or the yield to maturity, or RD, you'll also see RD, is 10%, and we have semi-annual compounding. Okay, so this timeline here just represents the number of compounding periods. I'm not going to have you fill out a timeline for these because they can get very long and time consuming, but just so you know, the face value, if the face value is $1,000, that means at the end of the period, you will receive back your $1,000. Okay, because it's semi-annual compounding for 10 years, that's twice a year for 10 years, so that's why we have the 20 compounding periods here. And we have a 10% coupon payment, and we're going to calculate those coupon payments as well. So if we look, we have our timeline drawn already, and if we look at our variables here, we have a coupon rate, we have the RD, which is the yield to maturity, T, the number of years to maturity, N is the number of compound periods per year, and F is the face value of the bond. Let's dig in a little bit deeper into this. So we have our coupon rate, which is 10%, and that's how much the buyer gets periodically in terms of the coupon value. The RD, or the yield to maturity, is also 10%. T is how many years to maturity, and that is going to be 10 because it's 10 years. N is the number of compounding periods per year. It's happening semi-annually, so that is 2. The face value of the bond, I'm going to write it FV, but that's the face value or the par value. That is $1,000. So we want to find out, what are we going to pay for the bond today? So how much are we going to pay for the bond? Bonds can be bought at par value, which is the same as their face value, which is the value that you would get at the end of maturity. They can be bought at a discount rate, so that's lower than the face value. They can be bought at a premium, which is greater than the face value. So we're going to see what this bond will cost us. If we were to buy this bond, given the parameters, how much would we have to pay for it? And to do that, you actually will use the present value function in Excel to calculate that. Okay, so remember, for present value, we need a couple of pieces of information to plug in. So remember, we need to put in the rate And in this case, what we're talking about is the rate. So in Excel, if you look at your function, the first one is rate. That is the coupon rate. Now we have to remember a couple of things here. We're compounding semi-annually, so all of our information here has to be turned into semi-annual, not the face value, ignore that part. But we need to put these into everything else in terms of semi-annual, or we will get an incorrect value. So my coupon rate is 10%, but semi-annually, that's going to be 5%, right? Because divided by 2. And then our RD, or our yield to maturity, that's also going to be 5%. We're just turning everything into semi-annual terms here. Now the number of periods, right? This number of compounding periods for the whole of the investment. If it's a 10-year maturity and it's being compounded twice, the number of periods is going to be 20. So the RD, this is not the rate that goes into the Excel function. It's going to be the coupon rate. Okay. So this one right here, not in Excel. We do not put that in Excel. The other variable for present value is payment. And we actually do have a payment, and that's going to be our coupon payment. So how do we find our coupon payment? Well, we have a coupon rate of 10% here, and that's based on the coupon payment. It's based on our face value, which is $1,000. So if I were to do $1,000 times the 10%, I get $100. Okay, but remember, this is semi-annual compounding. So I need to take that $100 and divide it by 2, because you're getting it twice a year. So you're getting $50 every 6 months as part of your coupon payment. Okay, because again, this is semi-annual compounding, so we need to turn everything into semi-annual terms. Okay. And then you will also see the FV. So the future value in the present value function, and you're actually going to put that in as what you're going to get at the end of maturity. And at the end of maturity, we're getting the face value, which is $1,000. And we're going to put that in as a negative value. Okay, we put that in as a negative value. So when we plug all that information into Excel, which we will do, sorry, you're actually not going to put that in as a negative value. That's going to go in as a positive value. So when you plug that into Excel, you're going to get the present value of your bond. And the reason why this face value or this future value is $1,000 is because that's money coming in. You're getting that money. You're not giving it out. So that's why it's a positive value. So once you plug this into Excel, you're going to get $1,000. Okay. So you're actually paying $1,000 for a bond whose face value is $1,000. So that is pretty common, and that is normally what happens. And you will know that if the coupon payment and the yield to mature, the coupon rate and the yield to maturity rate are the same. Okay, so if we have a coupon rate is equal to your RD, that means that you're paying par value. Okay, so again, if your coupon rate is equal to your yield to maturity, then you will pay par value for the bond. So you are paying $1,000 to the the issuer of the bond. You're giving them $1,000. In return, you will get a coupon payment of $50 every 6 months. And then at the end of maturity, so at the end of the 10 years, you will get this $1,000 back. Okay, so you're giving them $1,000. You get $50 every 6 months, and then at the end of 10 years, you get $1,000, which is the face value. So the present value is what you pay. The coupon payment is what you get per compounding period. And then at the end of maturity, you get the face value of the bond, which in this case is $1,000. So you're getting your $1,000 back, plus all of the money that you've made in the coupon payments. So what actually determines the interest rates of the bond, or the RD, the yield to maturity? Okay, because RD here is essentially what you get as a whole, including the compounding payments and then the bond payment itself. So it has a bunch of parts here. So our yield to maturity depends on the amount of risk and a number of other factors. So we have our star, which is the real risk-free rate of interest, and that's the interest that an investor expects from a risk-free investment. So if the investment has zero risk, that is what the investor would need to start off to invest in whatever it is. Next, we have IP, which is the inflation premium. So we would add on something to compensate for inflation, because as we know, as time goes on, inflation occurs. So things, its money is not worth what it once was because of inflation. So we also have to compensate for inflation. Then there is also the liquidity premium. So the more illiquid security is, the more they're going to add to the interest rate, because it's harder to turn it into cash. Then we have the maturity risk premium, and that compensates for taking more risk. So depending on how risky the bond is, that would increase the interest rate at that point. There is also DRP, which is default risk premium, and that compensates for the likelihood of the issuer defaulting on the loan. And then at the end of the day, when we add all of those up, we get the RD, which is the required rate of return, which is the minimum rate an investor will seek or receive for assuming the risk of investing. So the higher the risk, the greater the required rate of return. So this is the rate that is required in order for an investor to take out that investment. If the rate is lower than that required rate of return, then they will not take on that investment. So for the two types of bonds, we have treasury bonds and we have corporate bonds. A treasury bond is issued by the government, and that has a no default risk. The government doesn't really default on them. If we're taking out a corporate bond, that's a higher risk. They're more likely to default. So we would probably see a higher required rate of return for corporate bonds than we would see for treasury bonds. In terms of the relationship between bond prices and interest rates, as you can see, there's an inverse where the higher the bond price, the lower the interest rate, and vice versa. So as we decrease in bond price, we increase in the interest rate, right? We can see an increase in the required rate, decrease in the bond price. And when we say bond price, this is what you're buying. Okay, this is pretty much the present value of the bond. So that's how much you're buying the bond for. So the higher the bond price, the lower the yield to maturity here. So now let's talk a little bit about yield to maturity and yield to call. So those were a couple of the terminology that we went over in the beginning. So you can, bonds are usually issued and then held to maturity. However, some bonds can be called early. And in that case, you wouldn't get all the benefits of keeping it until maturity. So what we're going to do here is we're going to calculate the yield of a bond if it were to be held until maturity, and then we'll calculate the yield of the bond if it were held, if it were called early. So here we have a 10-year, 10% semi-annual coupon. The par value is $1,000, and par value means what you get at the end of maturity. It's selling for $1,135.90. So that's how much you are paying today for the bond. That is the present value. So that's the money going out. Okay? And it's a 10-year bond. However, it can be called after 5 years. And if it is called after 5 years, we would get $1,050 instead of $1,000. So that would be the future value in our yield to call. So again, the future value when we go to maturity is whatever the par value is. However, now that we have this the potential for it being called early, if it is called early, instead of getting this $1,000, we would get this $1,050. So if we look at the information below with the variables, you can see some of the things that I have already filled out. So N is the number of compounding periods, and I calculated it for the whole investment. And since it's 10 years, we have the 10 right here. And then it's semi-annual, so it's twice a year. So then we have 20 periods, compounding periods. The present value is what you are paying today for the bond. And it is a negative value because it is outflow. It's money that you're giving, that's going out. It's selling for $1,135.90. So this is what you would buy it for. So that's the present value of the bond. And that is what we just calculated in the previous problem. We calculated the present value. In this case, the present value is higher than the par value, right? So the price of the bond is greater than the par value of $1,000. Next, we have our coupon payment. Okay, our coupon payment is, we have a percentage of 10%. Right? Our coupon rate is 10%, and it's semi-annual. Okay, and it's based on the par value of the bond. It is not based on the present value of the bond. It is not based on the value of the bond at the end of the calling, if it's called early. It is simply based on the par value of the bond, or the face value of the bond. So we have $1,000, which is the par value, times the 10% interest rate. Okay, but it's a semi-annual coupon, and it's getting paid twice a year. So we're going to divide that by 2. So our coupon payment here is $50. And our face value here, future value, is $1,000. This is the par value. This is what you get at the end of the 10-year maturity time. What we are going to do is we're going to calculate the semi-annual rate and then use that to get our yield to maturity. Before we do that, we're going to move over to the yield to call info. So yield to call, we're going to see some different values. For yield to call, if it's called after 5 years, the number of compounding periods will be different because it's not for the full 10 years, it's only for 5 years. So in this case, we have 5 years, and it's still semi-annual. So the number of compounding periods for this case is 10 and not 20. The price of our bond, the present value, is the same. We're still paying the same $1135.90. That has not changed. Our coupon payment is the same because remember, it's based on the par value, and the par value does not change. So the par value of our bond is $1,000. Again, it's 10%, and it's a semi-annual compounding. So we get the coupon payment twice a year. So we divide it by 2 because it's $100 a year. Divided by 2 is $50. So our coupon payment is $50. Here, the future value, what do we get at the end? At the end of the bond maturity, or so it's not being held to maturity, it's being called early. So if it is called after 5 years, how much do we get? Well, we get this $1,050. Okay, so if it's held until maturity, we get the $1,000, the par value. If it is not held to maturity, if it's called after 5 years, we're going to get $1,050. That sort of compensates for the risk that you take for it being called early. So you get that extra $50. So notice how the only things that have changed when comparing yield to maturity to yield to call, what changes is the number of compounding periods, because it's not being held as long, and the face value or future value of the bond. So what we would get in the future at the end. Okay, so the coupon payment has stayed the same, right? The price of the bond has stayed the same. So the only thing that has changed is how long you hold the bond for, which affects the number of compounding periods. And then what you get at the end, which is the face value. So using this information, we can get the rates in Excel. And we would do that using the rate function. Oh, look at that, I write with my little highlight here, the rate function. I'm actually going to do this with you in Excel so you can see that, this exact example. So before we get to that, we're just going to go over how bonds are rated. It's how we assess the creditworthiness of a corporation's or a government's debt. We want to make sure that we are investing in bonds that are investment grade and not junk bonds. Junk bonds are not investment grade and they're not worth as much and they're much riskier. So we want to make sure that when we're investing in bonds that are rated in this area here. So they're rated both by Moody's and S&P. So we want to make sure that we get ratings of AAA, AA, A, or BAA for Moody's or BBB for S&P. This is just an FYI. And then we move into stocks. We're going to come back to this later in the second portion of the lecture. I'm going to post a video on doing the problems in Excel so you can see them. I will also post the actual Excel files so you can practice as well.